Welcome everyone to the monthly market update from Principal Wealth Partners. It is August of 2023. We are now in the second half of this year. The markets in July were positive across the equity, NASDAQ, Dow, S&P around 3 or 4%. And we are going to talk about a few areas of the market today that we believe important to the economy and the markets. I am joined once again by our founder and CEO, Bob Paolucci, and I am Julina Ogilvie. Welcome, Bob.
Hey, Julina. Thanks for having me back.
Always good to see you. And I think, as I just mentioned, we wanted to address just a few things that are important right now. And we know that we're getting a lot of questions on. Some of them we've talked about in the past, but the first one we wanted to address, which is very recent, is the downgrade of the US debt by Fitch. We want to talk about the valuation of the market. Are the equity markets cheap? Are they expensive? We want to talk about the Federal Reserve. After all of this time of rising rates, are we finally entering a period of lowering rates? And then finally, this conversation around a recession, why we think it's important that you can't have a recession when you have higher unemployment. Is that fair?
Great agenda.
Okay. I'm glad you think so, because you were really instrumental in putting it together. So let's first talk about the recent downgrade of US debt. I think the question that a lot of individuals have is, why is it important, and what exactly does it mean?
Good questions. It is important, right? It's real. Fitch downgraded the US credit from AAA to AA plus. It's one notch. And they provided a laundry list of rationale. We copied here some of the most important points, the heavier weight, really, behind their downgrade. And really, the rationale was an erosion of governance. And, they just go on to say over the past 20 years, it seems like politics in the US has gotten significantly worse, very polarizing on both ends. And, they provide detailed rationale that they see limited progress in Washington, and they expect the same for the next, handful of years. Number one. Number two, rising general government deficits. So we continue to spend significantly more than we make. Number three, government debt has risen substantially, and they expect it to continue to rise, maybe at a slower pace, but more so driven by compounding higher interest rates on that debt, and a lack of discussion around how to stop that from happening. And that is absolutely true. And then medium-term fiscal challenges unaddressed. So that is a cute way for them to say that Medicare, Medicaid, and Social Security, the entitlement programs, are growing like weeds, and soon they will really gobble up all of the tax receipts, all the income that this country has, if something isn't done about them. And ultimately, all of this says, if you do nothing now, we won't be able to do anything in the future. And that is true. That's just how it works. So, do I love the fact that Fitch downgraded the US credit rating? No. Can I see why? Clearly. And I think everybody can agree with most of this, some of this. It's unfortunate that Fitch downgraded the US, but it is what it is. What I should mention, there are three credit rating agencies for sovereign debt, and for corporate debt, and for municipal debt. There's the big three, right? It's Moody's, which is partially owned by Warren Buffett through Berkshire Hathaway. There's Standard & Poor's, and then there's Fitch. And the largest being Moody's, the second largest being S&P, and the third largest being Fitch. S&P downgraded the U.S. credit rating from AAA to AA plus 12 years ago. So you now have two of the three rating agencies who have downgraded the U.S. credit from AAA down to AA plus. So, Fitch just jumped on board. The commentary from Moody's is sort of the opposite. They're the one holdout saying, because we are the world's reserve currency and we are in essence the world's piggy bank, they don't see the need to downgrade only if they thought we were in a position where we couldn't pay our debts. And we certainly can pay our debts. This is more of a warning shot to Washington. That's what I view this as. And
Okay.
it's accurate. I think if you're in office while this happens, you are going to deny and blame and point the finger on anybody else, and that's exactly what's happening now.
Yeah.
But it did happen, and it's real. So,
Yeah.
ultimately, the what people want to know is how does it impact the capital markets? How does it impact me? And
Right.
generally speaking, I'll say for now, there's absolutely no impact, which I can prove. And hopefully, again, this acts as just a warning shot to Washington to start to plan for this stuff.
Right. Yeah. The
So
markets didn't seem to move at all.
they didn't.
Okay, great. And I think for those that we realize this is a very boring slide, but for those that maybe are a little bit more visual, you know, shout out to Kate on our team for putting this together. We usually borrow slides from others, but this was created by our own team, and I think it's a fantastic visual.
Yeah, so Kate Hartman, our very own Kate Hartman in the office, drew this picture as we were talking about our talking points for this meeting. And I think she pulled it off perfectly.
Yeah.
You have this long road that has caution flags on it, debt, China, Medicare, Medicaid, geopolitics, lobbyists, unions, Social Security, bags of money. You have this gigantic can that is the USA with dents all over it and a kick me sign on it. And you really have had this can that's been kicked down the road for so long by so many on both sides. We're nearing sort of the end of the road. You got to do something now. Up in the wings there, we have dollar bills with wings. We were talking about millions not too long ago. Billions entered the conversation about 10 years ago. And all of a sudden, 2 years ago, we're talking in trillions. Well, guess what? After trillions comes quadrillions.
Holy cow.
And coming soon. Give
Yeah.
us another decade, we'll be talking about quadrillions.
Yeah.
That's what happens when things compound.
Yeah.
Numbers get larger, and you start talking in these odd terms, and it is on the horizon. So you'll see this interesting big can that is being kicked further and further towards the end of the road. And unfortunately, on the other side of that, if we don't get our fiscal affairs in order in the United States, our independence turns into dependency, where we have to depend on others for everything.
Right.
You think about default, and not to say that this is going to happen, but on the other side of dependency and default is some type of economic depression. So we don't think that's happening anytime soon,
No.
and it shouldn't happen. But the longer we kick this giant can down the road, the closer we get to that stuff.
Yeah.
So,
and to your point, hopefully this downgrade is a warning, and there's plenty of time. And I think to take it just one step further, I think this is a great visual on what you were talking about earlier with the 3 credit ratings. You've got Fitch on the left, S&P in the middle, and Moody's on the right, relative to other nations around the world.
that's right. So what you see here is there's a AAA status across the board amongst the 3 rating agencies for, Australia, Denmark, Germany, Luxembourg, Netherlands, Norway, Sweden, and Switzerland. Those are the remaining all AAA rated by every agency countries. Canada has 2 out of the 3. US has 1 out of the 3. Moody's 2 that have downgraded. Again, S&P downgraded us back in August of 2011, and we had Fitch downgrade us August 1st of this year. So last week.
Yep. And I think also there's a nice visual on the right-hand side to point out that the downgrade was 1 notch, right?
It was 1 notch. Yeah, it's again, if we weren't the world's reserve currency, if we're not the piggy bank of the world, it becomes a slightly bigger issue. And that issue is the cost of financing, the cost of our debt rises. Our currency will fluctuate. We're not seeing that because of our status. So in essence, what I'm saying here is our status of who we are the leaders of the free world with the world's reserve currency, being the world's piggy bank,
Right.
is keeping us in a place where we're not impacted by this. All these other countries, if this happened to them, they would feel it more than us,
Sure.
if that makes sense.
Yep. We're
So,
still one of the best houses in a bad neighborhood.
absolutely. Yeah. I should mention just a few little things that maybe a few listeners would have questions about. Intricate details. When the country's debt gets downgraded from AAA, any new debt issued by companies and municipalities in this country
Mm-hmm.
cannot be higher rated than the country's debt.
Right.
So if you are
Great
Johnson and
point.
Johnson, right? Any new debt that you issue, let's say you were AAA rated, the corporate debt rating for any company cannot be higher than the country's rating.
Per that
So
rating agency, correct?
what's that? Per agency, correct. So now companies cannot issue bonds and get the same credit rating. New debt,
Yeah.
their old debt remains the way it rated the way it is, but new debt is impacted by this, and municipalities are also slightly impacted by this because oftentimes the backup funding vehicle they have for their municipal bonds are U.S. government uh, securities, treasuries that just
Yeah.
got slightly derated
Mm.
or downgraded. So there's a
Yeah.
some nuance there.
Yeah. No, that's a great point. Thank you.
So
And I think just one last slide that addresses this is talking about spending and the trends going forward.
yeah, it's this isn't a political statement. It's just math. The country spends way too much money, and Congress, which is supposed to be checks and balances, they need to do a better job of preventing us from spending way too much money.
Mm-hmm.
Look, it's no secret that spending gets you votes. Saying yes to everything gets you votes. But in our personal lives and in business, if you say yes to everything and everyone, you'll run out of money pretty quickly and you get into trouble pretty quickly. So that's sort of what's happening with the government.
Sure.
There are too many yeses and not enough nos, which means maybe some of the hardest calls aren't being made. Maybe some of the hardest things to tackle, the most difficult things to tackle in Washington aren't being tackled, and someone's going to have to do it, and someone's going to have to start talking about this stuff soon. But we just spend way too much money on top of our debt now being not only higher but more expensive.
Mm-hmm.
So higher interest rates not only impacts mortgage rates, car loans, corporate financing. It also impacts the government, especially when you have a boatload of debt.
Yep.
So you can see on this chart here that entitlement spending has gone through the roof and continues to go through the roof. But because of that, non-defense discretionary spending has to go down. Well, if entitlement spending keeps growing, there will be no discretionary spending, period.
Yeah.
That'll be zero eventually. Number one. Number two, there is this crossover, the very unpleasant crossover, where you compare all of the revenue that the government gets to entitlements, other mandatory expenses, and interest. And pretty soon, a permanent crossover will come where all of the money that the country receives goes to pay entitlement programs, mandatory expenses, and interest.
That's
That's
it.
that's coming soon. That's
Yeah.
the red dot on the screen there, and you can see that's sort of projected for sometime before 2030.
Right.
So the folks in Washington need to move very quickly to figure something out,
Yeah.
and they need to start talking about entitlement reform.
Yeah.
They have to.
Absolutely.
They have
Yeah.
to.
Changes need to be made, and it is interesting, despite all this. And thank you for going through this downgrade. When you look at the markets overall, we think it's important to talk about the valuation of the market right now.
Yep. Yeah. So the question is the market cheap or expensive here, right? So the S&P is certainly in a bull market. It's way above the October lows from last year. And the question is, well, is the market cheap? Is the market expensive? And here's an illustration of it. The top 7 stocks of the market, and we've talked about this, for a few meetings now, are leading the way in the market. Without them, the S&P 500 is barely positive. With them, the S&P 500 is well into positive territory. It is those 7 companies, we'll call them the Magnificent Seven, that are a little expensive, a little beyond where they typically are priced relative to their earnings. And because of the size of those companies, it is making the S&P 500 as a package look, a little on the high end of fair value,
Yeah.
somewhere between fair value and expensive.
Yes.
But when you remove those companies from the equation and you look at the rest of the market, the S&P 493, let's call it,
Yeah.
the rest of the market is not expensive. It's actually pretty cheap.
Yes.
That's a good thing for the market. That is a good thing for investors, that most of the market is not expensive. There's a small part that is a little pricey, but that's really about it.
Right.
That's really
Absolutely.
about it. The entire market looks less expensive if we project earnings going forward. And I think we have a slide covering that. So, here's the chart of earnings and forward earnings. And what you see is, last year, you started to see a slight earnings decline. And then the market late last year started to price in a significant earnings decline. They were trying to price in the future, saying, hey, we're starting to see a slight decline in earnings that might turn into a big decline in earnings. Well, what happened? The big decline in earnings did not happen. The slight decline in earnings continued to happen.
Mhm.
And now you have forecasts going forward for earnings to increase significantly. And that is why you had a market, it stopped the bleeding and then it turned around pretty sharply. And now we're back into bull market territory. So if you really look at valuations forward,
Mhm.
the market really doesn't look expensive at all,
Yeah.
through our lens.
Yeah. In other words, that red arrow going down was supposed to be a sharper decline than it was, which gave us almost a springboard for the green arrow to go up and for the continued earnings momentum.
Exactly.
Yeah.
Exactly. Earnings look really good. So this is actually a very good setup for the bull market, a very good setup for the equity market, and for things to come in the future.
Absolutely. Another reason to be optimistic.
Absolutely.
And let's talk a little bit about the Fed.
Sure.
And just so you know, I had a pop-up on my phone this morning. It was breaking news that they're talking about cutting interest rates in 2024.
Wow.
And we've been talking about this for a while,
We've been
so
talking
let's
about this
talk
for a
about it
while.
again.
Yeah. We've been talking about this. It was so unpopular. It was so against the grain. And maybe many listeners thought we were starting to lose our mind. But ultimately our view was that, look, we had a Fed that brought interest rates literally from zero up to a range of 5.25% to 5.5%, right? That is the short-term interest rate, the one that the Fed controls. That's very high. Jerome Powell himself says we're well into restrictive territory, which is code for interest rates are a lot higher than they should be.
Yeah.
For us, something usually breaks when they do something like that. And something usually breaks when they do it in a slow fashion, never mind when they rip the band-aid off and they go from 0 to 5.5. Feels like in just about a year. It's been about a year and a half.
Yeah.
What happened? Well, number one, they slowed the economy. Number two, they they caused a bit of a bank fallout in the small regional banks in the spring.
Mhm.
Number three, you now are seeing uh, credit rating agencies warn about higher interest rates and the impact on U.S. government debt. Fitch being the one who just recently downgraded U.S. government debt because they see that high interest rates blended with incredibly high levels of U.S. government debt creates a huge government expense.
Absolutely.
So I think the final nail in the coffin of the Fed's plan for rate increases was last week's downgrade of the U.S. credit. I'm sure Janet Yellen at the Treasury and Jerome Powell at the Fed had a brief conversation about this and maybe how it will influence the Fed's path going forward. I feel very confident that they chatted about this. The Fed doesn't have an official meeting now until September. The August meeting is this weird vacation meeting where they provide some commentary. They're vacationing in Jackson Hole, and they're going to
Yeah.
provide some commentary. And
All
then
eyes will still be on them at the meeting.
all eyes will still be on them at that vacation meeting.
Yeah.
And then their next action meeting is in September. And we expect in September, we don't expect them to cut in September, but we do expect them to continue with the pause path. And then sometime between September and the end of the year, they will likely start inserting some type of dovish easing language.
Mm-hmm.
We'll see how that works out, and I think that might be the new wrinkle here post debt downgrade. So
Yeah.
we think the next 1% move in interest rates is going to be lower. We think
Yeah.
the Fed's done and the next path is lower. This is a chart of the market starting to price in a rate cut in the March and May meeting of next year.
Right.
That's what this chart shows.
And as we've talked about in the past, but now that we're almost there, we not only are in an environment where we have higher income in our bond coming from our bonds, but we have this opportunity for appreciation, which are the blue bars on this page.
Yeah, so we've been saying for almost a year now that we're in a bond bull market, right? We started saying that at the end of the year, last year. It feels like monthly since then. And what we mean by that is yields on bonds across the board are significantly higher, near or beyond their 15-year highs. So investors, our clients, are benefiting from very high yields relative to where these yields were 5, 10, 15 years ago.
Mm-hmm.
Number one. Number two, what we're about to see is a Fed that goes from a rate hiking plan, moving rates up, to a sideways plan, which is what they're doing right now,
Mm-hmm.
to pretty quickly, we think, before you know it, a cutting program. Now, bonds do best when yields are high and rates start coming down. That is when you see maximum bond return.
Mm-hmm.
And this is a chart of the impact of what a 1% fall in rates and a 1% rise in rates will do to the price of bonds. And let's focus on the blue right now, because that's what's about to come.
Mm-hmm.
A 1% decline or fall in interest rates creates very high price moves for bonds. Now, for an investor, you have to keep in mind you get not only the yield on the bond, you also get the price move of the bond. So when we've been talking about a bond bull market, people giggling at us saying such a thing, this is exactly what we're talking about. You're very likely going to see well above average returns on bonds, at least for the next 3 years or so, which happens to match the Fed's targeted path for interest rates going out to 2026, which is lower.
Yeah.
That should be a very good environment for bond investors.
And I think it's hard for people to understand because it's been so long since we've gone through this.
Yeah.
And just to clarify too, this page, if you start all the way at the top, includes treasuries, short-term treasuries, all the way out to longer end treasuries. And you can see that they all have very, very good returns, starting at 7% all the way to 21. And then the lower half of the page are more corporate bonds, municipal bonds. These are very conservative pieces of the bond market, also with some more aggressive, if that's fair to say.
Absolutely. Yeah. And generally speaking, why is this the case? Well, I always try to explain to clients, if you have access to a bond and you get 6 or 7% and you have it for 5 or 10 or 15 years, right? That's a very good rate of interest. Now that bond, you're going to own it for some time. It's going to pay that interest for some time. If next year interest rates for similar bonds go down, your bond still pays that yield. You're still getting that income from the bond. In an environment where rates are lower, your high yielding bond is worth more.
Yes.
So you're still getting that income. And now, because the market moved rates lower, your bond looks significantly more
More
attractive
attractive. Yeah,
than new bonds issued at the new lower rate. That's how it works.
correct.
So that is on the horizon. That is coming soon to a market near you.
Yeah.
Stay tuned. We are very excited for this.
Oh, stay tuned.
Yeah.
And I think one last slide, we've talked about the recession, but one important piece that is, I think, critical to consider right now is where we are with unemployment.
Yeah. So a recession is very connected to unemployment levels, right? If you have a rising unemployment level, um, it means you're inching your way closer to a recession. Why? Well, about 70% of our economy is based on the consumer,
Mm-hmm.
right? It's consumer and government consumption driven. So as the consumer spends money, the economy grows. Well, let's back up a step. How does the consumer afford to spend money? You work. So if the consumer is employed, let's say we're at full employment, which I would say we're at right now,
Yeah.
an unemployment rate of about 3.5, then you have a healthy economy,
Yeah.
right? We have a consumption-based economy. If the consumer is not working and out of work, they're not consuming as much. Therefore, you don't have an economy that is growing as much. And in some cases, it might shrink a little.
Mm-hmm.
That's a recession. So the one outlier over the past 2.5 years when it comes to weak economic data has been the unemployment level. We've shockingly still had this, below 4% unemployment level now for about a year and a half.
Right.
And a recession has not been called yet because the one positive outlier piece here was very low unemployment. We're still there.
Yes.
What we did here is we took the um, lowest rate in the past 50 years for unemployment that had a recession in common with the rate, and that rate was about 4.7%. So,
That's the
what
red line.
yeah, what you see here, the difference between the blue line at 3.5 and the red line at 4.7, that blue line needs to creep up well into the fours to have any chance at having a called recession. We can have an environment where we have weak manufacturing data, where we have weak uh, service data in the economy. We might have a quarter of negative growth. But ultimately, if we don't have unemployment creeping up pretty substantially from here, it's very likely we won't have a recession. Now, this chart, I believe, is why most of these big Wall Street banks like Goldman Sachs and Morgan Stanley and Merrill Lynch and Bank of America and all these big companies who have been saying we're going to have a recession, it's guaranteed, 80% chance, 90% chance, they finally woke up and said, well, wait a second. We can't really have a recession unless we have a lot of unemployed individuals. So what you're hearing over the past 30 days is all these firms who have been so negative, scaring investors for months and quarters, finally pivoted and said, Bank of America said there's going to be no recession. Goldman says we're changing our odds of a recession from 65% to 20%. The biggest bear at Morgan Stanley said, okay, things aren't as bad as we thought they were going to get. It's unlikely that we'll have a recession. If we do, it'll be very shallow, very quick.
And
So
he's a bear.
he's a bear.
Yeah.
So everyone's throwing in the towel, and I think this is probably the most important data point. Without much higher unemployment, there is no recession. Period. End of story. The
I,
the the group of people who nominate a period of time as a recession, they will not call a recession unless we have a pretty dramatic rise in the unemployment level.
okay. Okay.
That's it.
And I think you bring up a great point. It's not to say that there aren't pockets of recessions that we could see, and we have seen some of that, and we may continue to see that and hear that. But overall, it's really hard to define an overall recession in terms of where we are. So
Right.
thank you.
Yep.
Well, despite some of the disappointing news in regards to the downgrade of debt and some of the concern it's created, we remain, pretty optimistic overall.
Yep.
When you look at the valuations, when you look at what the Fed is projecting to do, and when you look at sort of the recession determinants, if that's fair to say.
It's fair to say. I mean, it's like Fitch is trying to treat the government like they're an individual, and they're saying, "Look, we looked at your finances. You have this pristine credit rating. We don't see in the data your financials matching up with your credit rating. Your percent of debt relative to your economic output, your GDP, is astronomical, and that's not worthy of a AAA rating." So I hope that the psychological ding to our country's ego, our treasury's ego,
Mhm.
wakes up a little bit and creates some type of action. I hope our government follows through on this and they start to think about a better fiscal plan going forward that includes a lot less spending, because that's ultimately what has to happen. We're not going to be able to tax our way out of this.
Yeah.
There's no chance. So it really has to be a very, very thorough, strategic, effective spending plan
Yeah.
for the decades to come.
And we certainly hope that they'll start after the message that we just received. So
Yeah.
thank you, Bob, again for your time. And we thank everyone for their time and listening today. And as always, if you have any questions or concerns, you can reach out to any of us here at Principal Wealth Partners.
Absolutely. Thanks, Julina.